What's up, y'all? Everybody, this is Sunko, the Korean bro, and tonight is 2022 and March 7th, Monday night in Korea, and nothing's new besides the fact that I'm ill a little bit. I have a throat ache. Hmm. My throat hurts a lot. I don't think it's corona because last night or the day before I tested corona, and tester said that I'm not infected. Uh, but today, I woke up in the morning and my throat still hurt, and I felt something weird. So I took some of pills so that I could mitigate some pain within my throat. Uh, I know it's gonna get better, and, what made me worry was that the first uh, mm, the first step that you would have when you are infected, when you have corona, is uh, just like what I have. Like my throat hurts, right? When people have corona, their throat hurts at first, and then uh, it goes on to next step, such as headache, mm, and throat first, headache next, and then diarrhea or a mixture of every illness, and then at the end, a lot of sweat, stuff like that. There are a lot of effects that goes along with a throat ache. Anyway, luckily, pastor said I'm not infected, but hopefully it's gonna get better. At least I'm not sweating, right? Okay, let's go over stocks tonight too. Mm. Yahoo Finance. Because of uh crisis between Russia and Ukraine and spiking oil prices and rising inflation, geopolitical tensions, um, things are getting worse. So people are less likely to invest their money in their stock. Um, Tonight, we have another 14% down by Upstart Holdings. Mm, Let's look at the chart and see what's really happening here. Uh, mm, uh, Things don't look good these days for real. Hmm. Overall, it's all downtrend. Hmm. I'm like losing a lot of percentage ever since I invested money into it, but it's okay. Who would ever know the best timing, right? What I know is that now is the right timing because uh, every value of every company listed here are way above than uh, than its current price. So mm, once it's all done, it's gonna skyrocket. Mm. So let's look at it one by one. Mm. First, let's go over articles. Russia-Ukraine war has Wall Street totally confused. European stocks join global sell-off as bear market nudged at CPI inflation, Rivian earnings. What to watch this week? Stock futures seeing oil soars amid Russia's war in Ukraine. Stocks poised for bear markets as oil soars. Markets wrap. I think we're gonna see some spectacular returns, says Ark Cathy Wood. Three strong buy dividend stocks to consider as Russian-Ukraine war escalates. Oil traders bet prices will pass $200 a barrel, Joe Smith. Tesla rivals Lucid, Rivian, Fisker struggling to compete. Investors see bullish signals under the stock market surface. Putin's ruble workaround short-lived bond payments in doubt. Another rally coming in this trading market. Asian markets tumble as oil prices shoot higher amid calls for more sanctions against Russia. Always place a bottle on your tire when travail. China is hidden risk for emerging markets that split traders. Nothing seems interesting. Okay. Netflix is shutting all services in Russia. Okay. I picked like 7 articles. Once we are done reading it, I'm gonna go over stocks that I invested money into. Okay. Okay, well, what is it saying? This article first appeared in the morning brief. Get the morning brief sent directly to your inbox every Monday to Friday by okay, whatever. Where to go, where to do, what happens next, if occurs, what may not occur. That's the overarching mood, one of outright confusion on Wall Street, as its machine-like workers log over time to handicap the ongoing Russian-Ukraine war. I had one trader tell me he has been shorting oil in recent sessions, which by his own admission hasn't worked well as prices have surged to nearly $120 a barrel. Another person remarked to me they are still long buying stocks on expectations of higher yields and rising interest rates. Banks have been crushed. Uh, Post Russia's invasion of Ukraine, as those in the know reason the financial system was soon to be stressed due to the West sanctions in Russia. Mm. As part of that bearish trade, within the past 5 days, rating agencies Moody's has downgraded Russia's debt to junk, and on Friday lowered Ukraine deeper into junk territory. Moody's also said late Friday it's halting commercial operations in Russia. These actions are likely to have far-reaching implications across global markets. When will they? And what does that exactly look like? Nobody has any true idea, and neither does Mr. Market, as it's only down 3% in the past 3 months. Crude scenario exercise, where forecasts are largely driven by assumptions about the variables, which are clearly outside the realm of economic analysis, and where event specialists are forced to frequently revise their assessments given the new information they're analyzing day by day. This time, the key known unknowns are, of course, the development of war and the path of energy and commodity prices. The two are strongly correlated. Large price volatility in recent days seemed to be more driven by market speculation based on the news flow related to the war rather than changes in actual demand and supply. So here article says even specialists are confused uh, uh, by the phenomenon that they face. You know, the spike in oil prices, the rising inflation, and geopolitical tension uh, sum up altogether. It makes specialists confused. Hmm. I get it because it's hard for them to analyze because everything changes day by day. Yes, indeed. Stock market news live up the stock futures seeing all sorts amid Russia's war in Ukraine. Stock futures sank Monday morning, and oil prices soared as investors nervously considered the potential for even higher inflation and greater global economic damage from Russia's war in Ukraine and sanctions that have ensued. Contracts on the S&P 500, Dow and Nasdaq dropped more than 1% at session lows in early trading amid the risk-off mood. Traders piled into safe haven assets, and gold prices briefly jumped above $2,000 per ounce for the first time since September 2020. U.S. Treasury yields advanced. Okay, so here, oil prices, it's spiking, it's soaring heavily. I think we're going to see some spectacular returns, says or Kathy Wood. Given our expectations for growth in these new technologies, I think we're going to see some spectacular returns. That was the Chief Executive Officer of Art Invest, Kathy Wood, who gave an optimistic view of returns for the next 4 years in an interview with CNBC that published Monday. Wood's resilient view comes despite a 48% tumble over 12 months for her flagship Art Innovation Exchange Traded Fund, minus 4.79%, which has lost 36% so far this year. Technology stocks have been leading the declines for markets in 2022, with the Russia-Ukraine war also dissuading investors from the perceived high risk of some growth stocks. We've been in terrible bear market for innovation, said Wood. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Wu said that the war in Ukraine will likely lead to lots of demand destruction and substitution into innovation. Mm. Demand destruction. Given the surging prices of energy commodities, especially the prices of US crude 4.23% and European crude futures surged over 8% on Monday amid reports the US was considering a sanction on Russian oil. The CEO said the firm's inflows since January 17 have been significant and that many investors have been averaging down, which is a variable variation of dollar cost averaging, buying more when an asset's price is low. Investors who do this will often quickly see a strategy come back above that average, and if we're right significantly above that average over 5 years. Three strong buy dividend stocks as the Russia-Ukraine war escalates. So Valor Energy Corporation, Total Energies, Encore. See bullish signals on the stock market surface. It's been a rocky spell for stocks under the market surface. Some investors see promising signs. The S&P 500 has risen or fallen at least 1% in 6 of the past 9 trading days as anxieties over the war in Ukraine, high inflation, and the path of interest rates buffet the market. The benchmark US stock index recently suffered its first correction or decline of at least 10% from a recent high since the beginning of the COVID-19 pandemic. It is now down 9.2% this year, including last week's 1.3% fall. Despite the volatility, a variety of individual stocks have broken out. Among those setting records last week were Candy Maker. Okay. Many investors see reason for optimism when stocks from different corners of the market rally simultaneously. Such a move hint at the underpinnings of a durable advance, even when that has yet to materialize at the level of major stock indexes. That contrasts what periods in recent years when a big tech stock lifted the market while other sectors languished. That can't sustain itself forever. So I think that's been a healthy development, said Hank Smith, head of investment strategy at Haverford Trust. Even with this being another down the week, what you are seeing is there is buying power out there. Tech shares have pulled back this year as the Federal Reserve's plan to raise interest rates weighs on the high value that investors assign to those companies' futures earnings. The losses in sectors ranging from industrials to financials to healthcare have been less severe, and the energy group has shot higher. In one side of the outsized influence of big tech companies, the S&P 500, which is weighted by market value, is lagging behind a version of the index in which each constituent is equally weighted. Mm. While the recent stock market decline might make investors cringe, some point to signs that shares are poised for a rebound. Profits among big US companies are expected to grow more than 8% from 2021, and the stock market looks less expensive than it has since the early days of the pandemic in the wake of the recent sell off. And blah blah blah. Okay, people shows optimism, right? That's what's saying. I'm looking at this year as a race between earnings growth and PE contraction, said Jimmy Chang, Chief Investment Officer at Rockefeller Global Family Office. The question is, who's going to win the race? The pullback in stocks has U.S. equity market looking its cheapest since the spring of 2020. Coming in this trading market, okay, Netflix is shutting all services in Russia. No wonder, because why would they wanna run their service in Russia? Because even a lot of countries are having fierce sanctions on Russia, and they would not see any kind of business opportunity in Russia. Uh, so they will not have a connection. So Netflix has no reason to provide services in Russia, right? Okay. Anyway, is shutting its operations in Russia, one of the largest media companies, to pull out of the market following the attack on Ukraine. No new customers will be able to sign up. No new customers will be able to sign up. And it's unclear what will happen with existing accounts, the company said. The service has under 1 million customers in Russia. Wow, 1 million. Netflix, which has been operating in Russia through a joint venture with National Media Group, joins a growing list of companies from Apple Inc. to IKEA in suspending or terminating their business in the country after its invasion of Ukraine last month. Several holiday hmm, Hollywood studios have also paused the release of movies in Russia. The streaming giant said previously it won't be carrying required Russian news channels on its local language service in the country. It has also paused all projects and acquisitions from Russia, including 4 Russian original programs in production. It's getting harsh indeed. And let's look at some of the stock. That shows outstanding decline. The firm holdings down by 8%. Wow, wow, wow. The firm holdings, Emphasis Energy, Mega International. Wow, wow, wow. Equate down by 11%. And 11% by CE Limited, Toast, Frontier Communication parent. Digital Ocean Holdings down by 13%. 11% down by Endeavor. Silvergate, Coinbase, and Weave Communication, ASML Holdings down 5%. Last night, we looked through companies such as Mercado Libre, Latin America version of Amazon, and Wix.com, website creation company, and PayPal Holdings digital payments platform. And what's next? PayPal Holdings and Upstart Holdings. Okay, Upstart Holdings. Unfortunately, it's down by 14%. What tragic. Tragic indeed. Two top financial companies poised to challenge the market. Long-term winners in rough market. 7 stocks that analysts love for the 20% upside potential. This fintech's hypergrowth could last for years. The beaten down growth stocks could soar 140%, says Wall Street. For every growth stock you can buy and sell today. Challenge the market. Leveraging unique technologies. Upstart, Kinsale Capital, Remaining Finance, Upstart Holdings. Unique technologies. So, okay, they've got unique technologies. Okay. 2021 revenue rose 264% year over year. Recent earnings show these stocks are just beginning to write their long-term growth stories. Okay. So it's on sale, right? Obviously, it's on sale. Okay. As the market continues to sell off growth stocks report anything less than perfection during earnings season, it has been particularly eye-catching to see companies post gains after giving an update on their operations. While no single earnings call is typically make or break for a stock, a strong report with a promising forecast can be a hobby of good things to come. Such appears to be the case for two financial focused growth stocks that we will look at today, which not only reported solid earnings, but look beautifully positioned to continue building upon their long term growth stories. Okay, first one is Upshot Holdings and its artificial intelligence lending platform have exploded onto the investing scene since going public in late 2020. Going public in offering its banking partners a unique value proposition on credit risk. Hmm. Driven by its machine learning technology, Upstart aims to disrupt the traditional credit scoring system. And enable effortless credit based on true risk. Traditional credit scoring system. After rising more than 1,000% after its initial public offering, the company has seen its share price drop about 60% from its 52-week highs and has been one of the most volatile stocks in the market. However, from a strictly operational point of view, Offshore has been firing on all cylinders, including a promising fourth quarter report that led to its share price jumping over 30% in just the last couple of weeks. Okay, revenue increase, net income increase. Oh my god, transaction volume. Okay, revenue. Now partnered with 42 banks and credit unions, more than tripled its revenue and loan transaction volume. Transaction volume. Um, Now partnered with 42 banks. Hmm. Credit unions more than tripled its revenue and loan transaction volume from 2020 to 2021, highlighting the burgeoning popularity within its core personal loan operations. Best yet, the company showed its incredible profitability potential, recording a profit margin of 16% during 2021. What makes this profit margin all the more impressive is that its personal loan operations have yet to reach peak efficiency and could continue to improve as Upstart fine-tunes its AI and machine learning abilities. So it's not yet it's not yet perfectly suited for uh, its system to operate. The company has also begun dipping its toe into automobile lending, which has weighed on margins as it scales up. Ultimately, Upstart's market capitalization of $11 billion barely account for $6 trillion target addresses. Name the company has its eyes set on over a very long term. Expansion into auto lending and potentially mortgage lending down the road. Auto lending and potentially mortgage lending. I believe its fourth quarter results could be the first chapter in a long-term growth story. Okay. Cancel capital. Not this one. Finding long-term winners in a rough market. It's worth remembering that great businesses thrive in volatile markets. It's worth remembering that great businesses thrive in long-term markets, right? We have the Trade Desk, Airbnb, Nvidia, Shopify. Trade Desk. Emily J. pondered the threat of an avocado shortage in America and shared two stocks under their radar. Let's see what they say about Upstart. I'm looking at Upstart this week. The ticker is UPST. Upstart, as many investors will know, is an AI-driven lending platform. Let's see, lending platform. They reported earnings earlier this week and had an outstanding quarter. They saw an increase in their conversion rates, which means more and more customers coming to their platform get approved and apply for loans that rose to 24% a quarter. And more importantly, they are showing that they can expand from just personal loans into new industries, auto loans being one of them. So it's an interesting company. They're doing a really great thing for the world and their mission of trying to make credit more affordable to everyone. Credit more affordable to everyone. Make credit affordable to everyone. Last, based on things like FICO, I would say investors should probably keep an eye out on default rates. They need their algorithms to be better than the alternative. But this quarter is definitely pointing in the right direction. That's interesting, Chris. That the first time I've heard about Upshot Holdings today from Emily with a name like Upshot, you think maybe I would have heard a bit more sarcastically, of course. Hmm. Okay, so uh, I can notice that Upstart is one of the companies that a lot of investors talk about because uh here in this article even uh two people are out here talking about Upstart. The fact that they talk about this company is that it's one of the mm, hot companies that people look into. So okay, what's next? Mm, Five unstoppable trends to invest on $10,000 in right now. Uh, how much money is this? Okay, mm, investors should keep their eye on AI-based lending platforms, telehealth, fintech, the metaverse, and cybersecurity. Putting money into stocks related to these trends could help investors tap into years-long opportunities. There's a lot of instability in the stock market right now. Conflict in Europe, sky high inflation. Yes, 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 that's right. Artificial intelligence has been used by companies to improve their own businesses, but consumers haven't reaped the same rewards. Yes, not yet. Not me. Thanks to companies including Offshore Holdings, AI lending platforms are making it easier for people to secure loans. Secure loans without additional risk to lending companies. Offshore's platform uses AI to help assess potential borrowers by analyzing data points beyond the traditional credit score. So not traditional credit score, but they use AI-based platform. Hmm. Lending platform. Okay. The result is that more borrowers receive loans at better interest rates, and the percentage of borrowers who default on those loans is lower than for traditional banks. That's a win-win for both borrowers and lenders. Offshore focuses on both the personal loan and automotive markets, which represents a combined total addressable market of $739 billion. Topping off, Offset's fantastic opportunity in this space is the fact that it makes its money by charging fees to banks, lending institutions, not borrowers. The U.S. Department of Health and Human Services estimated that there was more than the asymmetry. Okay, let's look at this one. Wow. 14% down. Fintech. Financial technology or fintech is fast growing trend that all sorts of companies, from banks to technology startups, are owning in on. Is the broad term for nearly anything that involves using technology for financial transactions. Fintech with Apple Pay, as well as fintech specific companies including Block, Cash App, the metaverse. Okay. There are two last articles that are about Upstart Holdings. Let's dig deep into it, okay? I know it's now a lending platform. It's AI based platform. It makes people borrow money easily. Mm. It's a win-win algorithm because people can borrow their money easily and with much higher interest rates. And at the same time, it's it's not based on traditional credit scoring system. Uh, it's all calculated with AI based system. It's much more accurate, so people can believe it. Well, stuff like that. Okay, Upstock can still capture a lot of market share in personal loans. Meanwhile, Upstart or Auto should be a notable contributor to 2022 results. There are trillions of dollars in untapped opportunities ahead, making Upstart a compelling long-term investment idea. Okay. Fintech company Upstart Holdings recently posted an earnings report that the market embraced, sending the stock higher. Upstart's been on a wild ride since its IPO in late 2020. IPO trading between $42 and $41 per share over just the past 12 months. The stock now sits at almost $150 per share, and investors are probably curious how much upside there is. Hmm. Fear not, I will unravel the company's phenomenal quarter and detail why Upshot could continue posting impressive numbers. To reflect the vehicle credit score used by lenders in credit decisions, recent reported results for 2021, the company had fourth quarter revenue of $305 million, a whopping 252% year over year increase. Okay, fourth quarter, $305 million, 252% year over year increase, and smashing analyst estimates by 16%. Non-GAAP earnings per share came in at okay. The headline numbers are great, but there's more good news under the surface. Upstart's net income for the quarter was $59 million. Evidence that revenues are already vastly outpacing expenses. The company's cash on hand is now $1.90 million, and management announced a $400 million stock buyback program. It's rare for a company growing as fast as Upstart to begin buying back share. However, its profitability makes it possible. It's not like Upstart doesn't have any growth plans. Management is already expanding or will expand from personal loans into automotive, mortgage, and business loans. If Upstart can succeed and establish itself in these new categories, the resulting growth could last for many years to come. Personal lending is just getting started. Hmm. Upstart's algorithms were used by its partners to originate 1.3 million loans in 2021. Hmm. Okay, enough of Upstart Holdings. It's all positive. 14% down, but people are positive on trading this stock. What do we have next? Peloton Interactive. That's the last article, no, last company. And after this, I'll put an end to today's YouTube live. Okay. Uh, wow. 23.49. Hmm. Pastor founder could take a loss. Peloton Interactive. Woody's cut Russia's credit with prices soar. Sale is not in the cards for a company. I came out of retirement to make the company successful. Okay, let's look at this company profile. Its full-time employees, 8,662. And location of headquarter, United States, New York. Interactive fitness products. Interactive fitness products. Products in North America and internationally. It offers connected fitness products with touch screen that streams live and on-demand classes under the Peloton mic. The company also provides connected fitness subscriptions for various household users and access to various live and on-demand classes, as well as Peloton digital app for connected fitness subscribers to provide access to its classes. As of June 30, 2021, it had approximately 5.9 million members. 5.9 million members. Point 9 million members. The company markets and sells its interactive fitness products directly through its retail showrooms and at onepeloton.com. 2012, so it's been 10 years. Okay. New York. Could take a loss on its $55 million Hamptons mansion just months after buying it. Year of news ranging from bad to worse for Peloton founder John Foley. Just weeks after stepping down as CEO, he's reported listing his sprawling $55 million East Hampton home. Not really important article. Struggling this year, it stopped down sharply as we just mentioned. It has a new CEO. New CEO. Brian Sozi, you talked to him. He's known as well, I'll let you say it's pretty. A straight shooter, is that a good way to say? Yeah, that's a folk on the Wall Street knows Barry McCarthy, a new CEO of Patent. I wrote about this in the story. It's on the Yahoo Finance homepage now. Okay, it's just one problem after another for Paladin. It's got a lot of problems, so they have to overcome it someday. Mm. Was one of the hottest names in fitness during the pandemic. Mm. With more than 6.2 million members. Okay. A Paladin stock. This article came out in March 1st, so it's a believable article. Stock was one of the bright spots in the coronavirus stock market rally. Shares saw a gain of more than 440% in 2020, but after reaching a peak in January 2021, Patent stock has been on a steep downhill ride. Hmm. And the future of the company remains uncertain in the wake of layoffs and reported takeover rumors, though the buyout buzz recently sent shares soaring. So buyout buzz, but recent sell-off and recent layoffs. Hmm. Most of its revenue through sales of bike and treadmills. Sales of bike and treadmills, which range in price from wow, it's expensive, $4,295 for treadmills. The All Access membership for owners of its expensive equipment runs $39 a month. A digital membership is $12 a month to determine if Paladin stock is buy now. It's key to analyze fundamental and technical metrics first. Okay, fundamental and technical metrics. Fundamental and technical metrics. The Houghton reported wider than expected losses for fiscal quarter two and slashed full year revenue targets. The connected fitness platform reported a net loss $1.39 per share, or $439.4 million. Total revenue grew roughly 6% year over year to $1.13 billion. Has been on the wane after having a monster 2020. The fitness platform has an increased competition as more people return to in-person gyms and workout classes. More companies offering connected fitness products have entered the market as well. Okay, more competition, fierce competition, uh, layoffs ahead. With executive shakeup, co-founder John Farley announced February 8th he was stepping down as CEO of the embedded fitness company. He will take over as executive chairman. Former Spotify CFO Barry McCarthy will take over as Paladin CEO. Uh, Barry McCarthy. 20% of its corporate positions in a bid to restructure itself. Slump. Drew calls for potential sale from an active investor. So should you buy it or not? Let's look at this. Long-term outlook for Peloton remains intriguing, but the technical picture is weak. Bottom line, Peloton stock is not a buy right now. Not a buy. Not a buy. The stock has a long way to go to prove itself, with shares roughly 79% below all-time highs. Quarter one earnings send Peloton stock well below key technical levels. The fundamental and technical picture has only worsened with the equipment production hold. Equipment production hold. A takeover deal by Amazon, like your other suitor, could push up Peloton stock, which is already getting a big pop. But if a deal doesn't come true, Peloton shares could give up all those gains and more. Investors would do well to wait and see if Peloton can sustain an upward move and build a proper base before thinking about buying. Okay. Okay, that's about it today, and I'll be seeing you guys tomorrow, okay? Bye-bye.